In 2026, millions of people are starting to notice the same unsettling trend. Everyday life is becoming noticeably more expensive, and the pace of rising prices feels faster than anything seen in recent years. From housing costs to food prices, from energy bills to transportation expenses, nearly every major category of spending is becoming more difficult to afford for the average household. What makes 2026 particularly concerning is that these increases are happening across multiple sectors at the same time, creating a combined financial pressure that many people are struggling to keep up with. What makes 2026 particularly concerning is that these increases are happening across multiple sectors at the same time, creating a combined financial pressure that many people are struggling to keep up with. And according to some financial analysts, the most significant price increases may still lie ahead in the coming months. Gold. One of the first markets reacting to financial uncertainty is gold, as investors around the world move their money into assets traditionally seen as stable. Gold has historically served as a store of value during periods of economic stress, and recent trends suggest that demand is beginning to increase once again. As interest rates fluctuate and global currencies shift in value, many investors are turning toward physical assets to protect their savings. This renewed demand for gold may lead to price increases throughout the year as supply remains relatively stable. In previous economic cycles, similar patterns have often preceded record highs in gold prices. Real estate. Housing markets are also showing signs of increased pressure as new construction slows in several major cities. Limited supply combined with steady demand is pushing property prices upward in both urban and suburban areas. Mortgage interest rates are also affecting affordability for first-time homebuyers. As borrowing becomes more expensive, many buyers are forced to delay purchasing decisions. At the same time, rental costs are continuing to rise in response to increased demand. This combination of rising ownership and rental costs is creating financial strain for households. Oil and energy. Energy costs are expected to increase in response to growing global demand for fuel. Oil production cuts in certain regions may also impact fuel availability. Transportation costs often rise when energy prices increase. Electricity generation costs may also increase due to rising fuel expenses. These increases can eventually impact everyday household utility bills. Food. Food prices are being affected by transportation expenses and supply chain disruptions. Extreme weather conditions have also impacted agricultural output. Reduced crop yields can limit food supply in certain regions. This may lead to continued increases in grocery costs. Households may need to adjust spending habits accordingly. Global supply. Global supply chains continue to experience logistical challenges. Shipping delays can increase product costs. Manufacturing expenses are also rising. Labor shortages may affect production timelines. Market impact. Rising commodity prices typically influence production costs across manufacturing, logistics, and retail sectors, eventually leading to higher consumer prices as businesses adjust their pricing strategies to maintain operating margins. As production costs increase, companies often respond by reducing workforce expansion plans, delaying capital investment, or increasing service fees. Increased operating expenses may also influence pricing decisions across transportation and infrastructure sectors. Consumer impact. When housing, food, transportation, and energy costs increase simultaneously, household financial pressure tends to rise significantly, forcing many families to reallocate spending away from discretionary purchases such as entertainment, travel, and consumer electronics toward essential goods and recurring fixed expenses like rent, utilities, and insurance. Rising living expenses may also reduce savings rates as households allocate a larger share of income toward maintaining current standards of living, leaving less available for long-term financial planning, retirement contributions, or emergency reserves designed to mitigate economic risk. Increased borrowing costs combined with inflationary pressure can influence consumer credit usage, resulting in higher dependence on installment financing, credit cards, and short-term lending solutions to cover everyday expenses. Business response. Businesses facing higher operational costs may respond by adjusting pricing models, reducing workforce expansion, delaying infrastructure investments, or implementing cost optimization strategies to preserve profit margins in a volatile economic environment. Increased expenses related to logistics, materials, and labor often influence production planning decisions, potentially leading to reduced output or extended project timelines across manufacturing and service industries. Companies may also shift toward automation technologies in response to sustained labor shortages and rising wage expectations across skilled and unskilled workforce segments. Financial markets. Financial markets tend to react to inflationary conditions through increased volatility in equity, bond, and commodity sectors as investors adjust portfolio allocations to manage risk exposure. Institutional investors may increase exposure to inflation-resistant assets such as commodities, infrastructure funds, or real estate investment trusts. Currency fluctuations may also influence cross-border trade costs and import pricing structures. Future outlook. Economic forecasts suggest that price stabilization may depend on improvements in global production capacity, labor force participation rates, and transportation infrastructure efficiency. Policy decisions related to interest rates, taxation, and government spending may further influence inflation trends. Energy demand associated with digital infrastructure expansion may continue exerting pressure on utility costs. Global supply recovery timelines remain uncertain across several industries. Final. Combined cost increases across sectors create financial pressure. Economic cycles may change over time. However, current trends suggest continued price growth. Households may need to prepare financially. Understanding these factors is important. Financial awareness may help with planning. Monitoring expenses may become necessary. Planning ahead may reduce risk. Adapting to changes may improve stability. Preparing today may help navigate tomorrow's financial challenges. Understanding the combined impact of these economic factors may help households and businesses prepare for future financial challenges in an evolving global market environment. Financial awareness and proactive planning may become increasingly important as cost pressures continue to influence economic stability. Monitoring inflation trends and adjusting spending habits accordingly may improve resilience. Long-term financial planning strategies such as adjusting household budgets, prioritizing essential spending categories, increasing emergency savings, and reducing reliance on short-term credit instruments may significantly reduce potential exposure to inflation-related financial risks over time, especially during prolonged periods of elevated cost pressure across housing, energy, and transportation sectors. Adapting to evolving market conditions through flexible financial planning, expense monitoring, diversified income strategies, and long-term investment adjustments may improve economic stability for both households and businesses operating in a continuously changing global cost environment. Preparing today for potential economic changes by monitoring inflation trends, adjusting spending behavior, reassessing financial priorities, and maintaining awareness of global market developments may support long-term financial resilience in uncertain economic conditions expected throughout the remainder of 2026 and beyond.